This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, at the end of our previous session, we saw what was the approach to exam questions, understanding, of course, that in terms of those exam questions, anything in section A will be an individual 2-mark objective testing question, and your scenario-based question, which is what we're about to deal with here in terms of example 1, your scenario-based question is itself broken down into 5 individual requirements. Now, of course, those particular parts may represent the different issues that you see here. Again, broken into maybe 1 or maybe 2 questions on each of those particular parts of the problem. But we've got to follow this process in order to get us through, as it were, from the start in terms of what happens in lifetime and ultimately what happens on death. Maybe a little bit of admin at the end as to when the tax may be paid and by whom it may be paid. Let's just remind ourselves, though, about what that process is. The first exercise here in the first point, to compute the chargeable transfer for each lifetime gift. So we've got to look at the lifetime gifts that are relevant so far as our computation is concerned and establish what is the chargeable transfer. How do we do that? Well, we look at whether we've got pets or CLTs and list them out and go through on a chronological basis, applying, of course, the various exemptions as appropriate to the transfer of value figure, a transfer of value that we may indeed have had to have computed for ourselves. That will give us the chargeable transfer figure. Now, those chargeable transfer figures are likely in exam question to be a combination of CLTs and pets there. Again, probably 2 of one, maybe 1 of the other, whichever way round they want it to be. But a combination of CLTs and pets. And if there are CLTs, that's again a given almost for a section B question. Then if any CLTs have been made in the computation, then we need to put together the computation for lifetime transfers chargeable when made. Now again, that will only include CLTs. We exclude pets from this. We will be using the IHT rates and nil rate band applicable at the date of the CLT in terms of if that only includes transactions within the previous 7 years. We'll be dealing with a death for the Finance Act 19 anyway, probably in the 1920 tax year. And 7 years back, we've always had a nil rate band. All the way back to 0910, we've had a nil rate band, of course, of the current £325,000. But as we'll see in the next lecture, we may indeed be taken back to dates prior to even that, odd though that may sound at the moment. But it's not a problem in this first example we're going to be dealing with. So, establish the chargeable transfer figure for each lifetime transfer, whether it's a pet, whether it's a CLT. Our working moves through from left to right across the page, looking chronologically at each of those pets and CLTs, working from transfer of value down to the chargeable transfer figure. We then pick up from that table any CLTs, and that allows us to do our first IHT computation, that of course being the lifetime transfers chargeable when made. When dealing with that, of course, we need to have identified within the question not just the amount of the chargeable transfer that is the CLT, but also who is paying any tax thereon. Is it a net or is it a gross transfer? Who is paying the tax? Net transfer if the donor pays, gross transfer if the trustees pay. We then get through to inevitably what will have happened within such a question, the death of the taxpayer. And that death requires then 2 further computations. The first of which here in section 3, and that is where, of course, we're going to be working out the calculation of for lifetime transfers chargeable on death. Now that's where, of course, anything falling within the 7 years before death, be they pets, be they CLTs, will fall chargeable. Pets, of course, for the one and only time, but CLTs may have had, of course, some amount of lifetime tax paid thereon. I say may because certainly a CLT could potentially be covered entirely by the then nil rate band. But if there were any lifetime tax, that would have to be deducted. But that, of course, would only be deducted after having applied taper relief. Taper relief, of course, will apply both to pets and CLTs. We have something that's chargeable because it's made within the 7 years of the date of death. But if that transfer made in lifetime, be it CLT or pet, is more than 3 years prior to the date of death, then taper relief is available. Now again, you'll probably remember, of course, the levels of taper relief, moving from 20% if we've survived for between 3 to 4 years from the date of the transfer to the date of death, 20% for that, up to a maximum 80% taper relief if we've survived for between 6 and 7 years from the date of transfer to the date of death there. Not that you need to remember those figures, because of course that table is provided to you on your rates and allowances pages. Once you've dealt with the lifetime transfers chargeable on death, we can then move to our chargeable estate. Now, we could compute the chargeable estate at any point in time. It wouldn't have to be done last, you could do it first. But the only problem is you would then need to know what value of lifetime transfers were chargeable within the 7 years before death to know whether or not, in taxing that chargeable estate, we had, of course, any amount of nil rate band available. What you've also got to consider, and consider only, of course, on the chargeable estate at death, is the availability of any residence nil rate band. And that's based on, was there, as referred to, a main residence held by the taxpayer at the date of death? And then, of course, to whom has that gone? It's got to be a direct descendant in relation to the availability of the residence nil rate band. In each case, as regards those the basic normal 325,000 nil rate band, and also the very specific residence nil rate band, you also need to know whether or not the spouse or civil partner of the individual who has sadly now died predeceased this particular taxpayer, and whether then they used some or all of their original nil rate bands and residence nil rate bands. Because if they didn't, then of course the relevant proportion that was unused passes now through to their, well, as was, surviving spouse, but sadly now deceased. But the unused nil rate bands would have to be computed from the first death of the first spouse or civil partner to die. So plenty to keep us thinking about there. But remember, in terms of a Section B question, these explicit requirements will be broken down to do this for 2 marks, do that for 2 marks there. What we will see here is our overall approach, going through this order, because we have to go through this order to get to the end figures of tax arising as a result of the death of the taxpayer, and we'll show it in that form. Again, at any point, any one of the 5 questions within the Section B question could be asking you for a specific figure. Like, for example, the first computation we'll be doing, once we've read through the question, will be to compute those chargeable transfer figures. Right, example 1. What do they want us to do? Compute the amount of IHT payable, both during Joe's lifetime and upon his death. Right, during Joe's lifetime. That therefore would mean we're only talking about CLTs. Do we have any transfers into trust? And upon his death. That of course means we're looking at 2 computations there. The lifetime transfers, now chargeable on death. That will be any lifetime transfers falling, of course, within the 7 years of the date of death, and then our chargeable estate. So in total, some 3 computations, but to be able to deal with the CLTs that were chargeable when made and all of the lifetime transfers chargeable on death, we need to know for each lifetime transfer what was the chargeable transfer figure. Before we get to that computation, let's just read through the information in the question as we would in the exam and pick up, of course, what the relevant figures and relevant issues are. So here we go. Died on April the 1st, 21 there. Again, we have our hero, Joker, a very practical man, who sadly died appropriately on the 1st of April 2021. Now, that, of course, is relevant because we're going to have to go back in terms of looking at the lifetime transfers some 7 years before that. So that would take us back to the 1st of April 14. And any transfers from that date through to the date of death there, falling within the 7 years before the date of death, they will become chargeable on death. What did Joe do in terms of his will? Leaving £250,000 to his wife. A transfer to a spouse. What do you know about that? That is exempt. The remainder of his estate to his son, that therefore will form the basis of the chargeable estate. In calculating the chargeable estate, we will have listed out, as we'll see here, the assets held by Joe at the date of his death, and we will then have deduct any exemptions. Now, the only exemption available on death in our syllabus anyway is transfers to spouses or civil partners. And there we've got £250,000 to his wife. That is to be deducted in deriving the value of the chargeable estate. That chargeable estate then is the bit that goes to his son, and that, of course, will then require the tax computation thereon. So what did he have? At the date of his death, Joe owned the following assets. Now here's some interesting language. His principal private main residence, valued at £300,000. Now for IHT purposes, the only important words here are main residence. Because if it is your main residence, then depending on where you are now bequeathing that main residence, that of course would be eligible or may be eligible for the residence nil rate band. Now, of course, the value that we take into the estate will be the value of the property, £300,000, less we've got an outstanding repayment mortgage. So this is to be deducted the amount at the date of death, £80,000. So that will net out to some £220,000 there. Now, will the residence nil rate band be available to you? Well, yes, because £250,000 was being gifted to the wife, and the remainder of the estate, we may reasonably assume, therefore, that that includes that main residence, is transferred to the son, i.e. a direct descendant there. So on that basis, we will have the resident nil rate band available to us. Now, there's no reference here to any previous spouse having existed and having transferred any unused nil rate band or residence nil rate band across to Joe. So we don't have any problems as regards unused nil rate bands of a former spouse here. So that means we've got our basic figure, which for 1920 tax year is £150,000 there. That being lower than the net value of the main residence means we'll get the full £150,000 deduction as regards that residence nil rate band, not as a deduction, that nil rate of tax there of £150,000 will apply in relation to the chargeable estate, which contains that property with a net value of £220,000 there. One further issue. These words, principal, private, and then we've got residence. That might trigger something in your heads. Principal, private residence. Ooh, I seem to remember there was a principal, private residence relief. Does that mean it's exempt? No. Examiners may give you enough rope, as we've seen before, by which to hang yourself there. Terms that we are aware of from a different tax used within a question on a different tax to that one. Principal private residence relief is a CGT issue. It has nothing to do with IHT. Your main residence is probably the main value asset for most taxpayers within their chargeable estate there. So don't go thinking, this is PPR. It's that relief. That means it's exempt. No, it doesn't. This is IHT, not CGT. So don't be taken in. And we'll see that issue with other assets listed here that might again provoke a thought about using the word exempt, but that is applicable to a different tax. It's not applicable here. A holiday home valued at $140,000. We've got the value. Bank and Building Society deposits valued at $230,000. ISAs with a market value of $50,000. ISAs. Now again, you might think, ISAs. I've seen that before as well. They were exempt. Well, they were exempt in terms of the income from them for income tax and any disposal of them from CGT. There's no exemption in terms of IHT, so they are again to be included as a part of your chargeable estate. We've also got 12,000 shares in Joe Limited, which we're told there are valued at that date at £20 per share. So that's a simple exercise to perform. We've got a life assurance policy. Again here, what they may do, and if they do, we need to know how to choose between two different values. An open market value that existed at the date of death and the figure that we need, which are the proceeds from that particular policy, and that's £140,000 received following Joe's death. That is the figure for us then to include within the chargeable estate. Now again, given that it's objective testing questions, you're not going to put, as we will show you in the back of these notes, a formal answer where we list out very, hopefully neatly and tidily, the content of the estate. All we need to do is to add up numbers to get the value of the estate, take out, of course, any exemptions. We know we've got that in relation to the gift to the bequest to the wife there, establish the chargeable estate figure. We can't yet, of course, do the tax calculation thereon because we don't know about the lifetime transfers and whether, as will probably be the case, and will here be the case, that we'll end up, of course, having used up all of our nil rate band on the transfers within the 7 years before death. Remember, of course, that the residence nil rate band will not have been used up. It is only applicable to that main residence held within the estate at death. It's not applicable to any lifetime gifts of a main residence. Okay, so we'll come back to that. But of course, in getting the value of the chargeable estate, we said it was like a balance sheet, and that has both assets and liabilities. So we're told that Joe had outstanding credit card bills of $6,000. That's an allowable liability, and that therefore, existing at the date of death, will be deducted. That's an allowable deduction. But then it also verbally promised to pay the medical expenses of £1,000 of a friend. That is not a legally enforceable debt. That will not be an allowable deduction in establishing the value of the chargeable estate. Funeral expenses, yeah, we've got that lovely point about reasonable funeral expenses. Again, that might seem like a big number, but again, that is going to be taken, and you automatically assume here, unless it was an incredibly large number, where they might tell you, spent £50,000 on the funeral, whereas a funeral would normally cost £6,000. Reasonable funeral expenses would be the figure to be allowable as a deduction. So that too is an allowable deduction there. So we can deduct the credit card bills and the funeral expenses, again in deriving the value of the chargeable estate. And now we get down to the trickier part. And that is, of course, the lifetime transfers that were made. Now remember, we're again only taxing on the death of the taxpayer those transfers that were made in the 7 years before death. If, of course, we've got a CLT, then we also need to establish any lifetime tax that was payable thereon. and do that computation before dealing with the death computation. But what have we got? What was the date of the death there? Joe passed away, sadly, on the 1st of April 2021 there. So our first lifetime transfer, they're given here in chronological order, was on the 20th of November 14. Well, 7 years on from the 20th of November 14 would be the 20th of November 21. Our hero, as we saw, just died on the 1st of April, i.e. that is within 7 years of that transfer. So this particular transfer is relevant. What type of transfer is it? Well, it's a cash gift of £40,000, and there we go. That was the critical information, to his son. That therefore means that it is a pet. It is also on the occasion of his wedding. Anything special there about weddings? Well, obviously there's lots of things special about weddings there, but in terms of IHT, it is, of course, about the marriage exemption. And where it is from parent through to child, that is a £5,000 marriage exemption. But of course, as well as those very specific exemptions, like the marriage exemption there is also the more general annual exemption that needs to be dealt with. Again, do make sure that down here, or in any of the requirements to any of the questions, they don't say something like ignore annual exemptions. If they did, of course, we would ignore them. But assuming that that is not going to happen, we need to recognise what annual exemptions would be available. Assuming that there were no prior transfers to this, they've told us everything we need to know, then this transfer, dated the 20th of November 14, that therefore falls in the 14-15 tax year. So it would be eligible for the annual exemption for 14-15. And as we can see that, again, after even the marriage exemption of 5,000 taken away from 40,000, there's still a lot of transfer that would be chargeable. So as well as firstly using the current year's annual exemption, we would also be able to then deduct the annual exemption that was, we must assume, unused from the previous tax year, and that would be 1314. So look at what we've got from that initial reading of that one line. The nature of that lifetime transfer is a pet. It will only be chargeable on the death of the taxpayer, and only if that is within the 7 years of the date of death. We've established that it is within the 7 years. We know the value, the transfer of value. It's a cash gift of £40,000. But we need to work the chargeable transfer, and that's after deducting those lifetime exemptions. Firstly, the specific exemption, the marriage exemption here of 5,000. Why? Because it's to the child of the individual, here to Joe's son. And also then any available annual exemptions. Firstly, the current year, that's 14-15, followed by the preceding year, 13-14. We move on. 15th of July 15. We're now into the 15-16 tax year. And that's going to mean that, of course, here we'll have available the annual exemption for 15-16. We've already used the 14-15, so this July 15 transfer will only benefit from the one annual exemption for the tax year that it falls in, the 15-16 tax year. Transferred 405,000, there's your transfer of value, into a trust. So now we know critically that this is a CLT. And what do we then also need to know about that? Because when you see that figure is 405,000, even after the deduction of an annual exemption, we are clearly going to exceed £325,000. And that means that any amount of this chargeable transfer above the available nil rate band That again in lifetime would have been £325,000. That therefore was going to be chargeable in lifetime at the relevant lifetime rate. Remember, when dealing with CLTs on the very first IHT computation we prepare, lifetime transfers chargeable when made, then we ignore any pets, other than the fact that, as we've just seen, they would have taken advantage of any annual exemptions that existed. But other than that, the first and only computation for lifetime transfers chargeable when made, first and only transaction for that, is going to be the transfer into the trust. And for that, the lifetime tax chargeable when made, we need to know who pays. And we're told, transferred into the trust and paid the IHT due thereon. So Joe, the donor, paid. That therefore means that it is a net transfer. So when we come to the computation, any excess above the then available nil rate band is going to be taxed at 25%. More of that later. The last of the lifetime transfers, the 8th of December 19. Now that one, of course, is falling in the 1920 tax year. So we've got AE 1920. Have we used 1819? No, we haven't. So we'll have the 1819 annual exemption available as well. Let's see what it is. Gave 4,000 shares in Joe Limited to his son. So again, we're dealing with a pet. Just like the first transfer, we have a pet here. But when dealing with shares in what we'll discover here is, as it's limited and unquoted company, we have to use, where appropriate, that transfer of value principle, where we look not at the market value of the shares being gifted. That is what you'd have dealt with at the time when dealing with the CGT implication. But what we do instead is to look at the transfer of value measured as the difference between what did the taxpayer have before the transfer and what does the taxpayer have after the transfer. So what have we got? Prior to the gift, Joe owned 16,000 of the 20,000 shares in Joe Limited. Now you can see down here that as regards percentage shareholdings, we get different values per share. And very clearly and practically, of course, as in reality, the bigger the interest you have in such a company, the higher the price per share. No one's probably interested in a 1% interest in an unquoted company. I am rather more interested in 51%, 75%, 100%. And therefore, the bigger the interest, the higher the share price. So what we're going to have to do to compute the transfer of value before then deducting any exemptions, we've seen that 2 annual exemptions would be available here. But to get the transfer of value, we look at what did he have before 16,000 shares, with what did he have after having given away 4,000. Well, that will be 12,000 shares. And then apply the relevant price for those 2 relevant shareholdings. To begin with, 16,000 shares out of 20,000. 16 out of 20 is an 80% shareholding. So here, in terms of the 80% shareholding, £25 per share, your transfer of value computation would be based on, before the transfer, 16,000 shares held. After the transfer, given away 4,000, 4 from 16 is 12,000 out of a total of 20. That therefore is going to be some 60%. A 60% shareholding has an £18 per share, so times £12,000. The difference between those 2 figures will be your transfer of value, and we'll see that computation in a moment's time. We're also told that the nil rate band from the tax year 14-15 has always been 325. Well, we knew that anyway, but they'll tell you. If you have to use a nil rate band from a tax year earlier than your current tax year, for us it's the 1920 tax year, then I'll tell you what that figure is. Also, the one final comment here, of course, share valuations agreed with HMRC at that date were as follows. Those are the figures that we can validly use here. All right. So we picked up a lot of information here from that first read through. We understand what will be the eventual content of the chargeable estate and how to put it together, though we'll leave that exercise in the detailed form to the end. We also know that we've got both types of lifetime transfer having occurred within the 7 years before death. There is a lifetime transfer chargeable when made, a CLT, a transfer into trust. It was the only one made, remember, in the computation, the IHT computation of lifetime transfers chargeable when made, we only include CLTs. We ignore pets on that computation. Pets are not chargeable when made. They are only chargeable if you die within 7 years. So that means that given the amount we had, okay, the transfer of value was 405, it's going to be diminished by an annual exemption, I think it was there, but we're still going to have a figure that takes us above the then available nil rate band in 1415. Tax year 1415, that of course should be 1516. Again, possibly by the time you see this lecture, that will already have been updated. Sorry, that should have been updated from an earlier year. So there, 15th of July 15, there, that's in the 1516 tax year. It's 325,000. We knew it was going to be. We've had 325 since 0910 tax year. Okay. Going back to our approach, therefore, albeit you are guided in your section B question, if that is the most likely place to find it, I think you will there, but that's where it is, by the individual questions. What is each of the 5 questions specifically asking you to do? But to be able to move on to any of the IHT computations, which are clearly going to be a part of these requirements, a fundamental part, you're going to have to compute the chargeable transfer for each lifetime gift. Now, it's perfectly possible that an exam question may give you those figures and simply ask you then to go on and work the computation of the tax. That's maybe more likely within a section A rather than a section B question, but it could happen. Here, it hasn't. We have to work out transfers of value. We know what they are now. We've done that. Take away the exemptions. We know what they are. And get the chargeable transfer. So what I'd like you to do, therefore, is to set up that first computation of the chargeable transfers. You will list them out chronologically across the page from the earliest to the latest. We had November 14, July 15, December 19 in there. You will state what each of them is, a pet, a CLT, a pet. You will compute the transfer of value. One of those will require a working. The other ones are just taken straight from the question, of course. Again, in terms of any OT question, it is not a working that you have to identify to show. That only happens in section C. The basis of course, a transfer of value calculation on the shares was this exercise here. You know what needs to be done, you work it out. So work for me, please, the chargeable transfer figure. So pause at this point, work the chargeable transfer figures, and we'll pick it up from that once you've done it. Okay, well, let's see how we fared on our first task there. Now, again, we should be familiar with the working required to get our chargeable transfer figures here. And that is, we list out across the top of the page, by date order there, the transactions that have occurred, the transfers made within the 7 years before the date of death. We get the transfer of value figures. Those, of course, in the case of the pet on November 14 and the CLT July 15, are cash figures given directly within the question. This one, of course, the pet for December 19, That we had to work out for ourselves. That was the classic transfer of value exercise, the difference between what we had before and what we had after the transfer. We had 16,000 shares prior to the gift of those shares. That was an 80% interest, and they were valued at £25 a share. That therefore in total would give us 400,000 as compared to afterwards. After that transfer, what do we have? 4,000 shares were given away, 12,000 shares remain. That was a 60% interest, and they carried an £18 per share price. Giving us in total 216, take one from the other, transfer of value 184,000. Now that could be a separate question in its own right to compute what that transfer of value figure would indeed be. But otherwise, the figure we've now computed goes into our chargeable transfers working. And what do? We take away from that the various exemptions transfer by transfer in order to bring us down to the chargeable transfer figures. Those figures we need because they are then the figures to include within the various IHT computations, be it the lifetime transfers chargeable when made or the lifetime transfers then that are chargeable on death. We'd already identified on our first run through, our first reading of the question, that in relation to the November 14 PET there, we had a marriage exemption because it was to the son, that was 5,000. We then had two annual exemptions in order, remember, firstly the current year, followed by the preceding year. Those were both £3,000 apiece. They've always been that. They've never changed, 3,000. That means we've got a total of somewhat 11,000 to deduct, and hence a chargeable transfer computed at £29,000. For the CLT, there was just one exemption available, the standard annual exemption, available just for the tax year in which it fell, 15-16. That was £3,000. That PET there, though not chargeable when made, only chargeable on death, will have been deemed to have used the relevant annual exemptions for the year in which it was made, and if necessary, as here, for the year prior to that as well. So we've only got one annual exemption to go against the value of the CLT, and that therefore reduces that just slightly, but down to £402,000. The final PET, the transfer of the shares, we've done our transfer of value. There were no other transfers made in that 1920 tax year, so it enjoyed that annual exemption. We didn't have any transfers in 1819, so that's an unused exemption. It's brought forward the 1 year it's able to be carried forward for, and that gives us two lots of 3,000. That therefore is 6,000 away from 184, and there's our 178,000. Step 1 done. We've computed the chargeable transfers. Step 2 was the first of the IHT computations to be prepared, and that of course was for lifetime transfers chargeable when made. That is only CLTs. We've got one of them there in July 15. So what you now need to do is to set up that computation that you can just see here at the bottom of the screen, lifetime transfers chargeable when made. Now, what you'll need, don't want to show you too much there, give it all away. You can probably see it anyway on the page in front of you, but look away. You need to have 3 columns, a working column, into which the basic chargeable transfer figure will go, your 402,000. You then, based on who pays any tax above the available nil rate band, compute the IHT, and if, as was the case here, I think we saw it was a net transfer, then of course we add the chargeable transfer to the tax to give us the gross transfer. So if we just pause at this particular point in time and have a quick go at that, shouldn't take you more than about a minute, I hope, to do that computation. Okay, let's see what we have then in this lifetime transfers chargeable when made. Now, do understand that when dealing with lifetime transfers chargeable when made, as we know, we're only dealing with CLTs. We know the amount of that CLT, 402,000, and it goes into this working column here. But also understand that it is only these transfers are chargeable. Pets were not chargeable when made, and only on death if you died within 7 years of them. That you are applying the then available nil rate bands that existed. For us, of course, it's likely to still be the 325,000 as it is here. It is only the CLTs that are consuming that in lifetime. You don't hear say, oh, but we had this pet that predated it, that was £29,000. Has that therefore used 29,000 of the nil rate band? Not in lifetime, not on this computation. When you do this computation, again, sneaking in just beneath this, just at the bottom of your screen, lifetime transfers chargeable on death, then yes, that pet there, back in, when was it, November 14, does become chargeable. And therefore, it will be taken account of. It will use the first part of the nil rate band that was in force at the date of death, which is still £325,000, of course, there. But here, lifetime transfers chargeable when made, no. There is only the CLTs. How much was the figure? We know 402. That goes above 325, so the full 325 nil rate band is available. It's the first CLT that has ever been made by the taxpayer. That therefore uses up the 325 nil rate band and means that out of the 402, it leaves 77,000 to be then taxed at 25%. Why? It's a net transfer. Why is it a net transfer, demanding the net rate of 25% to be applied to this figure rather than the gross rate of 20%? It is that because the donor, Joe, paid the tax thereon. So 25% of that, hopefully 19,250, that goes into your IHT column. Because this transfer was a net transfer, to get the gross amount of the transfer, you add the two figures together. The amount of chargeable transfer figure plus the amount of tax thereon, because both of those figures diminish the value of the estate. We've already worked out the chargeable transfer figure, but also, of course, what further diminishes the value of the taxpayer's estate. Joe pays that amount of tax out. That reduces the value of estate. So the gross is the combination of the chargeable transfer, 402, the IHT 19,250, 421,250. And that was it. There was only one CLT there in that particular exercise. Now we need to know this figure. Of course, this was July 15. You're dealing with the date of the death of the taxpayer. We're dealing with that debt in, 2021, 1st of April 2021 there. So what we understand and what we have seen is that every one of the 3 lifetime transfers that we are informed of has fallen within the 7 years before the date of death. So each of these is going to be chargeable. Now we know the chargeable transfer figures for both of the pets, the 29,000, the 178,000. And those become chargeable once, only on the occasion of death. They will be charged a tax just the once, and at the rates applicable at the date of death. The 402,000, as was for the CLT, that was chargeable when made, and the gross amount of that transfer will also go into this computation here, the lifetime transfers chargeable on death, because it too falls within the 7 years before the date of death. Of course, we will reflect the fact that some lifetime tax, to be precise, £19,250 of lifetime tax has already been paid, and that will serve to reduce what may be otherwise any additional tax that needs to be paid as a result of the death of the taxpayer. But of course, even before we reduce the tax charge within the computation, lifetime transfers chargeable on death, even before we'd reduce that tax charge by the amount of lifetime tax paid, there is another deduction, of course, that is available not just to CLTs, but also to pets. Any transfers that are now chargeable, pets and CLTs, on death because they were made within the 7 years before the date of death, any of those transfers, if they are, though less than 7 years, and they're hence chargeable, they are more than 3 years from the date of the death of the taxpayer, then of course taper relief is available to us. So you now have got to put together that computation. You don't need the little working column as we had here. We just need gross transfers and IHT, and we then go through in chronological order. Again, you can see firstly coming in there in November 14, that pet, where we know the chargeable transfer was 29,000. We use now the nil rate band that was in force at the date of death. That again was 325,000. But if it had changed, you now use in this computation the nil rate band in force at the date of death. Then 29,000 is clearly less than 325, so there will be no tax. We will then pick up, or you will then pick up, the gross amount of the CLT. That, of course, will take you above 325,000, and therefore you'll then have to have however much of the nil rate band still available at nil, the balance of the chargeable transfer, the 421,250, that goes above the nil rate band. Remember, this is now tax on death, and that brings with it that hideously high 40% IHT rate that is applicable. Once you've worked out a figure of tax, of course, look at the dates. Yes, it's within 7 years. Was it more than 3 years? If so, between how many and how many years from the date of death was that transfer, to establish the level of taper relief. And that will then be applied. But because it was a CLT, as we've said, we've also got the lifetime tax to deduct there. Regarding the first transfer, the original pet of 29,000, taper relief is irrelevant, because taper relief only applies if there's a tax charge. It's a reduction in the tax charge. 29,000 was all within the nil rate band, so there was no tax charge. It's only relevant in relation to the tax charge. Once you've dealt with that one, of course, you've then got a further pet to deal with, dated December 19. You know the figure. Establish, of course, whether taper relief would also be relevant for that one. I'll leave you to decide on that. So, can you please complete this computation for me? Pause now, and you have a go at that. Okay, picking up it again then on the lifetime transfers chargeable on death. Hopefully a successful exercise on your part there. We knew that we go through from the earliest transfer within the 7 years before the date of death through to the date of death and deal with each of those lifetime transfers, whether a PET or a CLT, in course. The first one, November 14, a PET, a mere 29,000, well within the 325,000 nil rate band, so no tax to pay. Bring in the gross amount of the CLT there from your lifetime tax computation. That was 421,250. Clearly that takes you above 325,000 on this cumulative total. When we add 421,250 there to the 29,000, we've got £450,250. How much of the 421,250 is chargeable at above nil rate? Well, what nil rate band was left? From the 325, you've used 29, that leaves 296. 296 is at nil. 296 out of 421,250, that leaves £125,250, therefore, and that will be taxed at 40%. That, all being well, comes to 50,100, and there is your tax figure now to include. Now that's your tax figure based on the use of the nil rate band, but of course it isn't the amount of tax that has to be paid as a result of the death of the taxpayer within the 7 years of making that transfer into the trust. What we have to begin with, you must do them in this order, is taper relief. So again, the date of this transfer was July 15, so you count forward. July 15, so July 16, 17, 18, 19, 20, 21, had lived for 5, doesn't live for 6 years, between 5 to 6 years, therefore 60% level of taper relief. Deduct that from your original tax charge calculation. And because there was lifetime tax paid, we now deduct that lifetime tax paid, that figure taken from the previous computation, 19,250. So we started with £50,100 as the 40% charge on the excess above the nil rate band. But of course we end up, after taper relief, after deducting lifetime tax paid, with a mere £790 there. That additional tax due to be paid, that will have to be paid, of course, by the trustees. Nobody else left to pay that. Paid by the trustees, taking, of course, that £790 out of the value of the trust itself. One final pet to deal with here, December 19. Now, of course, December 19, with the date of death of April 1st, 2021, that is within 3 years. So here, there'll be no taper relief. It's a pet, so there's no lifetime tax paid. We have already used up our nil rate band. The cumulative total at this point, within the 7 years before the date of death, is over £450,000. So all of the 178 is chargeable at 40%. That's 71,200, and that's it, because there's no taper relief, and of course there is no lifetime tax that has been paid. In relation to the pet, who pays that? The donee. Don't add down any total here in this IHT column, unless a question, and it's very unlikely that it would specifically ask you to do that, to calculate it, because those are separate liabilities. Whoever benefited from that first pet, I think it was the son, paid no tax on the £29,000 chargeable figure. The trustees of the trust end up paying additional tax of £790 on top of what they had paid, or what had been paid. It was the donor who paid it, Joe, but on top of what had been paid in relation to the lifetime transfer that was chargeable when it was made. That £790 paid by the trustees. As a totally separate payment, again, I think it was the son that benefited from that particular pet, they would, he, or she, he, obviously not she, he would have to pay the £71,200. So the £790 and the £71,200 are separate liabilities. Right, that's the hardest part done, that computation, the lifetime transfers chargeable on death, and it means that all that now you're required to do is to put together your computation of the chargeable estate at death. There is no need, as there wouldn't be any need in the exam in an objective testing question, to formally list them out as I've shown in this particular answer. You would already have picked up the numbers from the reading of the question. Just get your calculator out, make sure you use it very carefully, of course. List out the values of the assets, take out any debts or liabilities, take out any exemption. Don't forget the spouse exemption here in terms of what was left to her by Joe. Get the chargeable estate. You will then know that given that in lifetime, in the 7 years before the date of death, you had that amount of transfer, clearly there is no nil rate band that still remains to go against the chargeable estate at death. But there is, of course, still a nil rate band to use, a very specific one. Don't forget to apply it. Over to you now. Work that figure for me, please. You can check it out with the answer there, but I'll have a quick chat with you before we bring this lecture to a close. Okay, let's see what you've got there for. Your list will have included, you got your main residence, which after the mortgage had come to, a figure we'd already identified on the question page as being 220. We've got the holiday home, we've got the bank and building society deposits, we've got the ISAs. Yes, all of this is chargeable. There's no exemption here in IHT. We've got the shares at their given value at the date of death there. And we've got the life assurance proceeds to come in, bringing us to an asset total of £1,020,000. Take away your debts, liabilities due at the date of death, and also any reasonable funeral expenses there. Take those out, £12,000, and then, of course, any exempt bequests, i.e. to spouses or civil partners there. That was £250,000, and that brings us to a chargeable estate of £758,000. In terms of that chargeable estate, we know, of course, that there's no nil rate band available to us, but there is a residence nil rate band. We had that main residence, 220. It was gifted to the son, a direct descendant, and therefore the maximum 150,000 was available. That will be at nil. The balance of that chargeable estate then at 40%, and that creates the liability on the chargeable estate to be paid out by the personal representatives. They paid out from the value of the estate. Who is it borne by? The residuary legatee. So what the son gets will be everything other than what went to the spouse, less the amount of tax charge thereon. The 243,200 will come out of the residuary legatee's share. Okay, that's the first exam standard question in terms of the information. Obviously, the question itself would be made up of 5 individual objective testing questions that would have covered the specific issues that we've dealt with there. And that happily brings this particular lecture to an end.